Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast. I'm going to be talking about tips or sharing my tips for investing in your 30s and 40s. And this is a little bit exciting because it's a little bit younger than most of my beautiful members that I deal with or the people that come to see me for financial advice. But the 30s and 40s are really a time where you can really set yourself up for financial success. And it's a time where, you're young and everything's happening and, the big R word, the retirement word is so far away. It's hard to sort of focus on those concepts while you're young and living life and enjoying life. But what you do in your 30s and 40s will make such a huge impact to the end result. And it doesn't have to be anything extraordinary or over the top. It can be something quite simple. So what I'm going to do is I'm going to talk about how to navigate the investment world in your 30s and 40s, because it can be quite an adventure. But I will make mention, as I said, it is a significant part of your life and you will have a significant impact to the end result when you want to retire or you want to have a few more options on how you work, how many days you work, whatever that looks like for you. It's all good. So I'm going to share with you 3 practical strategies and some common pitfalls to avoid, so you can build your financial future in a secure way and get to where you want to with less pain and not feeling like, oh my gosh, we kind of buggered up the 30s and 40s, so we better get on our bike in our 50s and 60s. So the first thing I want to share with you is what I call the cash holding conundrum. So don't hold cash, invest. One of the common pitfalls or the widely spread thing that goes around that people believe is that you should keep a certain amount in cash or low risk investments. You are in your 30s and 40s. Trust me, you have got time to outlive type of thing, all the ups and downs of the investment world. Keeping money in cash and keeping it for security purposes or thinking that it's low risk is really not going to benefit you. It's actually going to hold you back from having the ability to potentially, home ownership, preparing the kids for education, and really building a robust retirement nest egg for yourself at the end of the day. So don't be afraid and kind of hang on to that cash and think that you need to have cash or low risk type investments, because time's your best friend. You're only in your 30s and 40s. If you're 40, you've got minimum 20 years before you can even touch your superannuation. Now, why do I always mention super? Super tends to be one of the biggest investments that we all have as part of our investment portfolio. You can retire whenever you want, provided you've got enough assets producing the amount of income you need to live. Most of us don't do that. So, most people don't have that ability or that nest egg set up to be able to do that. So super seems to be the place where we kind of put that line in the sand of where we're going. So if you're 40, you've got 20 years before you can touch your super, which is the biggest part of your portfolio. And you'll have other non-super investments, which is what I would suggest without a doubt. If you're 30, you've got 30 years. That's a massive amount of time in investing. So you don't need to go the low risk route. You need to actually get on your bike, work out what your risk profile is and get invested, because time is your best friend and time is going to help you get there. And investing in those long-term capital growth investments, they will pay dividends provided you stay the term of that investment. And I guess I'm jumping ahead to my next one, but making sure that you're investing in good quality assets and not taking undue risk. Because again, you've got time on your side to be able to get the benefits of investing in long-term investments. The second thing is You need to take some form of risk, but calculated risk, not silly risk. What's silly risk? Well, listening to your mate at the pub who said that his, brothers set up a new company and they're floating, and the share price is going to go through the roof, and you throw in 50,000, next minute's worth nothing. That's not calculated risk. That's just silly risk. I don't sort of recommend doing that, but focusing on smart calculated risk towards investing in an investment that's going to reap you the dividends. So when we talk about taking calculated risks and not unnecessary risk, I want to share a story with you I have had over the many years that I've been sitting in front of clients who have invested in investments that promise 10 to 15% return. So the first question you need to ask yourself is this: wow, I can't get that at the 4 banks or anywhere else in the market. Why is this so high, and what is the risk level? Because this is a perfect example where I can talk about risk and return. High risk, high return. If the return's high, the risk is high. Then you need to ask the next lot of questions. Where is my money being invested, and do I still have access to my capital? So in this particular instance, with a number of clients I've had over the years, they've gone and invested in mortgage trusts. What's a mortgage trust? Well, they're basically giving their money to developers and property people who are looking for funds to build and develop properties and so on, or second mortgaging, for example. Second mortgaging is quite risky, and they're promising them 10 to 15%. The problem here is there's a couple of problems here. 10 to 15%, you can't even get that in a high growth managed type fund or an ETF. You're definitely not going to get that at the bank. So you must halt and say, hang on, this sounds too good to be true. What are the chances of that consistently paying me that 10 to 15%? And how real is this going to be? Number 2, is my capital secure? And when can I get my capital back? Because in those type of mortgage trusts, there is no what we call primary market to be able to then sell that investment so you can get your money back. So what's an example of a primary market? Example of a primary market is the Australian Stock Exchange. So when you buy and sell shares, you can buy and sell them every single day of the week. That's a primary market. You can get in and get out. But when you're in mortgage funds, there is no primary market. You've got to wait for the next guy or the next investor to come through to want to buy yours so you can get out. And sometimes, if the developers haven't taken off and been able to fulfill their part of the bargain of the loan monies that yours has been pulled in with, then your asset is then illiquid, and you've got to wait for them to come good before you can get your funds out. And I've seen multiple clients in this particular situation that have invested in their 30s and 40s, chunks and chunks of money. They're just about to retire and they can't access their capital. And that 10 to 15% return has also halted. So they're stuck in a really, really bad position. You don't need to be taking these type of risks. When you're in your 30s and 40s, you follow the tried and true methods of investing in top ASX blue chip shares in Australia. You invest in super, so super investment, non-super investment, sticking to your risk profile, your tolerance to risk. Don't reinvent the wheel. Just stick to the tried and true. Yeah, it's vanilla. It's not exciting, and you're not going to have stories to tell about how you doubled your money and so on, but you don't need to do that. You need to just take I guess I can say it's a lower risk option. Why? Because you've got the context of time on your side. You've got 20 to 30 years before you can touch your super. I'm not saying invest it all in super. You're going to invest outside of super as well, but that's the time frame you've got in which you can make these investments happen. So take calculated risks and tried and true methods. You don't need to reinvent the wheel. We know that these investments will return the growth that you're looking for over that period of time. So why would you want to take unnecessary risk if you don't have to? So that is absolutely one of my other criteria that I would absolutely look at, and one of the pitfalls I wouldn't be falling into. So, and then the other the other part of that equation is that you're diversifying, you're getting access to all the other asset classes, it's being invested, and that diversification is smoothing out the volatility of your investments. Happy days. And away you go. You got to keep an eye on it as you go. You got to add to that investment. But they are the most basic things that you want to be looking out for. Then we move on to mortgage offset accounts. I see this often, and this is probably one of my, this is the third tip, but one of my most important tips that I can share with you. It's really common for people to put absolutely everything they've got in their offset account because they're desperate to pay off this home loan as quick as possible, yeah? So they seem to just pop it in the offset account and do nothing with it. That's a massive opportunity cost that you can't replace. What do I mean by that? Yes, it makes sense to have all your excess funds. Let's look at two sides of the equation. It makes absolute sense to put all your excess funds into a mortgage offset account because, particularly if you've got a high mortgage, what does an offset account mean? It's simply offsetting the interest on that loan by using the capital of the offset account. So let me put it in these terms. Say your loan's $650,000 on your house and you got $50,000 in cash. That $50,000 in cash the bank is counting to offset against the $650 and only charging you interest on the $600 rather than the $650. So it makes sense. However, what it doesn't do is it doesn't allow you to make use of that $50,000 again in an investment, in a way to invest for your long-term future. So diversifying, getting invested into the market, you've got the long term ahead of you, and your ability to create that sort of growth for yourself is really important. What I always say is, in your 30s and 40s, you got to get real up close and personal with your cash flow. Don't take the easy road out. Pay the mortgage, get invested, do both at the same time. Don't go down the pathway of, oh no, I'm going to pay my mortgage first and then I'm going to invest. No, you got to do both. You got to stretch the friendship with the cash flow. Use a portion if you want to in your offset account to reduce that, but don't allocate all of it there. Allocate some to an investment and get the benefit of diversifying different asset classes, growth assets, and away you go. Because that money sitting in your offset account is simply saving you interest, but it's not growing anywhere else. There's no diversification. It's all in your family home. One asset class, one asset type, and no diversification whatsoever. By the way, your home doesn't put money back in your pocket. It's not an investment per se, but what it can be for your future, if you choose to leverage off that, and that's in another podcast episode that I'm going to share with you, but your home can become an asset if you choose to leverage off any equity to invest in property. And when you do retire, if you decide to downsize and there's a lot of equity in there, you can also use that equity to help you booster your super, to have greater capital in your super that'll help you retire even more comfortably. So at those points in time, it can become an asset to you. But generally speaking, if that's your home and you're not going to use it to leverage into property and you're not going to downsize, it doesn't put money back in your pocket. So you've got to do both with the time frame that you've got. You've got to invest for the future and you've got to pay down your home loan at the same time, because if you choose to pay off your mortgage in 10, 15 years, you've just lost, if you were 30 and you had 30 years to go, you just lost 15 years of investment time, which is critical to the overall end game. I can't stress that enough. When you're in your 30s and 40s, your best friend is time. The rest of it is, don't keep too much in cash. Make sure you're taking calculated risks and don't dump everything into your offset account. Get invested, add a savings plan to it, get friendly with the cash flow, and make it all happen to some degree. That all comes down to your cash flow analysis. So the cash flow analysis is, again, knowing what's coming in and what's going out and continuously being all over that. And the more you do it, the more empowered you become, and the more in control you're going to become of your financial position, and it's just going to get easier and easier and easier. So with that said, thank you for joining me on this wonderful episode of this podcast. Please make sure you subscribe to our podcast on your favourite podcast platform, and I look forward to sharing my next podcast with you and catch up on our previous episodes.